Well, Robert Prechter, the founder and CEO of Elliott Wave International, advised betting against stocks, I should say, 3 months before the market peaked back in October of 2007. Now he says stocks are very overvalued. He sees a major decline ahead. Bob joins us now from Atlanta to discuss what's behind his most recent market call. Bob, welcome to the show. Thanks for joining us.
Thanks very much.
So first of all, we should say that the target that you're looking at would say that there would be another third or so decline for stocks, 34% or so decline from stocks from these levels. Talk to us about your methodology here and how you arrived at this conclusion.
Well, all of the indicators that I follow were very, very bullish in late February and early March. And these include indicators of momentum, how fast the market was falling. It was actually slowing its decline. Indicators of how the investors were feeling. And we had very few bulls at that time. Everyone was afraid of the worst contraction since the Great Depression. So you had momentum slowing. You had sentiment improving, and the Elliott Wave model of markets that I use said we were coming into the fifth wave, which meant a bottom. So at that time, I was looking for the biggest rally since the high, and we had a target range on the S&P of 1,000 to 1,100. We've reached that area, and all of these same indicators, which I hope we can take a quick look at some point during this discussion, are now on the other side of the ledger.
So one of the things you're looking at, and you mentioned some of the indicators here, you're looking at advanced decline ratios, for example, for the Dow Jones, and also kind of putting that against a bullish and bearish sentiment. So talk to us about that.
Okay, if we're going to look at the short-term rally indicators that I brought with me, I've got a chart showing the advanced decline ratios. These are the peak advanced decline daily ratios of the past 6 months. If you'll notice, we had a 13-to-1 ratio coming off the bottom in March. That's a great kickoff. It's like a ball getting shot out of a cannon up into the air. In July, when we had the second liftoff, we had a 9-to-1 advanced decline day. That's also pretty strong. But all through August and September, the best the market could do is 4.2 and 4.8-to-1. That's an indication of a slowing upside momentum. During this entire period, of course, we've had declining volume. I'm sure you've had a guest or two mention that. Now, contrast the slowing upside momentum during this tremendous rally with the change in sentiment. At the bottom left, you can see that among traders, there were only 2%, according to the daily sentiment index, of traders who were bullish at the bottom back in March. And at the recent high in September, 92% of traders were bullish. This is a tremendous change. It's exactly what we'd expect to see, because you can't make a high without most people feeling optimistic. Now, so I think these are two sets of indicators saying the rally is aged, if not over.
Now, Bob, what happens if, we're going into earnings season here, we're going to start to get a lot of numbers this week, going into the coming weeks. What happens if these numbers blow away estimates? What happens if we continue to get some positive news flow that would give us another leg up in this rally potentially, or do you think that's highly unlikely?
Well, there are two things to say about that. Number one, remember back in February, March, all the news was bad. All the news was about declining earnings and dividends being cut, and all the negative economic news that was coming out. Now, ironically, that is the time when you want to be bullish, and that was one of the indicators we used. Bad news is a great smokescreen for a bottom. Now, ever since August, we've had all this good news come out, which we predicted back in March, by the way. Don't, wait. You're going to see an improving economy before the rally's over. News lags the market. So what we're seeing now is the lagging economic news coming from the market rally that's already occurred. So I don't think news is a very good way to buy and sell the market, certainly not in the direction of the news. I'd rather use the internal indicators.
But Bob,
if we have time, we've got another good one to show.
Bob, you also mentioned, though, that one of the reasons that you're basing your prediction is on what you call extreme levels of investor optimism. Define extreme.
Well, one of them, you just mentioned possibly improving earnings. The price-earnings ratio, the PE ratio, is at the highest ever in the last few months. You want a low PE ratio for a bottom. In the last 100 years, the PE ratio at bottoms has been 6 to 7. It's currently over 100. Now, people are projecting better earnings, but we only use the real ones that have already occurred, because projections include a lot of the optimism that we're seeing in the market. So we've got extreme overvaluation in the PE ratio. Let's take another one, which is the dividend ratio. Stocks, let's say the Dow Jones Industrial Average, average, for an example, it has an annual dividend yield of under 3%. It's about 2.95%. The last times in the past century when we had a yield that low were the top day in 1929, the peak in 1937, and the top in 1966.
Bob,
so we're still
here,
in this extremely overvalued area.
Just real quickly here, because I know you want to talk about your last chart. We only have about 30 seconds. The cash to asset ratio at mutual funds is also something you're looking at.
Well, this is a long-term picture. We've been talking about the short-term rally, but if you look back 50 years, you'll see that institutions hold very low levels of cash at peaks. They get bullish like everyone else and like their clients. They hold very high levels of cash at bottoms. And in the past 10 years, we've had extremely low levels. Here we are back to only 4% cash. I think that's another indication, just as we saw at the 2000 high and the 2007 high, that stocks are risky.
Okay, Bob, we're going to check back in with you at some point and see what has happened with stocks and if your prediction has come true. Our thanks to Robert Prechter. He's the founder and CEO of Elliott Wave International.